Hey, this is just a really quick video. I noticed something when I was going through the CFA course that was incredibly specific, and you'll want to pay attention, subscribe, and like the video because it might actually save you a lot of money in the long run, especially if you're someone who has their money managed. I'm not claiming to be a professional of anything. I just thumb through the boring stuff because I know well enough that the devil's in the details, and especially in this industry, if they could scalp you for a little bit more, they will. Just chalk this one up in the irony category because this time it involves ethics of all things. See, financial advisors, they can't lie to you because it technically violates their ethics. However, some of the tricks of the trade is that if you never ask, then they technically never lie to you. For example, if you ask your financial advisor if they're fiduciary, they can say yes because it can be true. They can be a fiduciary. However, this is the part where it kind of diverges. If you don't ask them the following question of, are you a fiduciary with everything you sell me? They could sell you the worst garbage imaginable where they get the highest kickback commission and where it doesn't even fit your financial needs or goals or any of that stuff, right? They're not violating any laws as far as I can see. Granted, I'm not a lawyer, obviously. But from my understanding, they didn't even violate their ethical code, so no reprimand from the CFA because you technically didn't ask them that question and they technically didn't lie to you. There's one extra thing I wanted to tag onto this, and I'll have to explain by drawing it. So traditionally, this is how the basic order flow goes. You or your investment manager tells you about a stock. You then make a decision. Hey, you tell your investment manager or money manager that, hey, I want this stock X amount or whatever, right? That investment manager or money manager then goes to the brokerage. The brokerage goes to find a counterparty to go execute the trade, and then you get your shares. Now, what can happen in this entire process is the brokerage here can offer something called a soft dollar commission to your money manager or investment manager. The gist of what the soft dollar is that they're essentially giving your stock that you're buying a slight little markup outside of the hard dollar fees such as the SEC fees, clearing fees, and brokerage fees. Now, if you're still lost with all the technical jargon and the diagrams and so forth, let me simplify it even more and make it very blunt. You're paying more for a stock than you have to be, and you're getting less back than you should be. And that difference and that excess is being pocketed by the brokerage as well as your money manager. Now, believe it or not, the reason why I'm talking about this is that this is a practice that's still done to this date. Have you ever heard of a mutual fund? And granted, I personally don't like mutual funds because there's a multitude of reasons, but typically these brokerages and mutual funds and stuff like that, they offer your manager some type of product like a platform, data, or research or whatever, right? And they justify that into the cost by saying, oh, well, your money manager or whatever needs this to do their job well, whatever, right? You're still footing the bill for that. And you might not think it's that big of a deal, but mutual funds don't perform quite well. And every penny kind of matters because every penny that's coming out of your pocket is going back directly into theirs, not yours. Now, technically speaking, this is unethical because your manager violated their ethics to give you the best execution, and some would argue the duty they have to uphold your best interest. But at the same time, you can't chase after someone for something that you don't know is happening, and you wouldn't even know if you didn't even ask, right? I guess the goal of this video is to mainly let you know that this is one of the many things that gets, flown under the radar, under people's noses that they couldn't care much about and didn't notice. And it might not seem like a lot. Like for interactive brokers, for example, right? There's a 1 to 5 cent soft dollar charge you can put on the money you manage and so forth. And that doesn't seem like a lot, and I haven't really dove too deep into the math for this thing, but I would guess you'd probably lose somewhere between like 25 to 40% of your entire investment. Again, this is a long assumption or whatever, right? But it's something quite significant I could see affecting you in the long run, especially if you are deeply invested into something like a mutual fund, which historically does not perform very well. But yeah, this was just something I came across that I felt was interesting enough that I wanted to make a video for that I didn't see a lot of people talk about. And yeah. Write down in the comments down below, let me know if you found something else shady, or maybe you sat down and did the math and see how much you actually lose for this thing. But yeah, just remember, just because you're a day trader doesn't mean you have to trade every single day.